Welcome back to the channel. This week, inflation came in cooler than expected, and that immediately shifted rate cut bets and bond yields. The relief rally was real, but confidence stayed fragile as traders questioned how durable this cooling trend really is. Looking at the year-over-year chart of CPI-AUCSL and CPI-FESL from 2021 to early 2026, you can clearly see the inflation spike of 2022 and the long cooling process that followed. Headline inflation has moved down much faster from its peak, while core has remained stickier, reflecting persistent services pressure. Into January 2026, both lines are trending lower compared to the extremes of the past cycle, reinforcing the narrative that price pressures have eased. That cooling dynamic is exactly what shifted rate expectations this week and pushed Treasury yields down. But the gap between headline and core still matters, because the Fed historically pays close attention to underlying core trends. So while the direction is encouraging for bulls, the chart also shows why policymakers are unlikely to declare victory too quickly. On Thursday, a fresh wave of AI disruption anxiety slammed risk appetite and spilled far beyond tech. Investors suddenly started asking which business models get squeezed when automation hits labor-heavy industries, and the selling spread across multiple sectors. Money rotated toward defensive corners of the market and into longer-dated government bonds, a classic risk-off tell. The jobs report finally showed up after the delay, and traders did not like the fine print. That revision shock instantly fed the jitters and pushed the market back into risk-off mode. Next, let's break down why this kind of data twist can flip rate bets in a heartbeat. Here is the payroll's pulse check, shown as the monthly percent change in U.S. non-farm payroll employment from the PAEM series. In a nervous tape, traders fixate on each new bar like it is a verdict on the entire economy. But payroll data is notoriously revision-prone, so the real shock is how fast the story can flip when prior months get rewritten. That is why even a seemingly normal month can still trigger whiplash across rates and stocks, because confidence gets hit, not just the headline. And when the market is already jumpy, that uncertainty is fuel for bigger intraday swings. With that setup, let us look at the unemployment rate next, because it is the other half of the labor signal. Now look at the U.S. unemployment rate, because this is where the delayed job story turns into real market anxiety. After those choppy payroll bars, the line is almost unnervingly steady, sitting at 4.3% for January 2026. But zoomed out, it is not pinned at the cycle lows anymore, and that subtle drift higher is exactly what makes revisions feel dangerous. When the headline says jobs are fine but the trend line stops improving, traders start pricing a slowdown before it shows up in the next report. That is why this chart hit so hard in a jittery week. It keeps the door open for cuts later, while still screaming that the labor market is cooling at the edges. And in this kind of tape, even a tiny move in unemployment can flip the whole narrative from resilient to rolling over. Now trade policy is back on the front page, and markets can feel the tension instantly. Tariff talk and deal rumors mess with price expectations and supply chains in a heartbeat, and in a week already dripping with nerves, that extra uncertainty keeps risk appetite on a short leash. Here we are looking at U.S. customs duties receipts, and the level shift over the past years is impossible to ignore. You can clearly see how tariff waves translate directly into higher government revenue from duties. That spike after 2018 marked the first major escalation phase, and since then the baseline has remained structurally higher. What matters now is that renewed tariff discussions could once again push this line upward, reinforcing price pressures at the margin. And in a market already hypersensitive to inflation risk, even the hint of higher trade costs keeps volatility simmering just below the surface. Now we shift to the U.S. trade balance in goods and services, and this chart shows the long-running deficit that has defined the external picture for years. You can clearly see how the gap widened after the pandemic surge in goods demand, before stabilizing and narrowing at times as imports cooled. What matters here is that tariff headlines alone have not erased the structural deficit, which is driven by domestic demand, dollar strength, and global supply chains. When trade deals are announced, markets often react quickly, but this chart reminds us that the underlying imbalance tends to move more slowly. So even as tariff rhetoric heats up again, the bigger trade trend remains a gradual adjustment story rather than a sudden reversal. Over in Europe, the growth backdrop still looks fragile and uneven. Recent data confirmed only modest expansion in the euro area, while the UK economy barely moved, reinforcing the sense of a soft patch. At the same time, Russia cutting rates highlights how different economies are responding very differently to the 2026 cycle. Europe is still crawling, not sprinting. This euro area real GDP year-over-year line never really breaks into a confident uptrend. Instead, it drifts and dips, showing how fragile demand has been heading into late 2025. And when growth is this soft, every policy headline matters more, because markets start hunting for the next cut, the next stimulus, the next lifeline. That is why this story pairs perfectly with the Russia rate cut narrative, because different regions are already reacting to very different growth realities. Keep that in mind as we jump to energy next, because oil can turn a weak growth backdrop into a full-blown risk-off tantrum. Here we see WTI crude oil prices over the past year, and the move has been anything but calm. After sharp swings earlier in 2025, prices have traded in a choppy range, reflecting fragile global demand and ongoing geopolitical tension. For Europe in particular, softer growth means weaker energy demand, which can cap upside in oil even when supply risks flare up. At the same time, any surprise disruption can quickly tighten the market and spark volatility. So oil sits right at the intersection of growth fears and inflation risks, making it a key variable as central banks navigate 2026. Now zooming in on SPY, the SPDR S&P 500 ETF that tracks the broad US stock market, we are looking at a clear close streak below the 50 days moving average. That is not just noise, it signals short-term pressure building after a week packed with inflation relief, but lingering growth anxiety. Even though the CPI print cooled and Treasury yields dropped during February 9th to 13th, 2026, price still could not reclaim that 50 days line, which tells you buyers are cautious, not confident. So, this is where the emotional pulse of the market really shows up, because traders want to believe in rate cuts later this year, yet they are not willing to chase risk aggressively. In a defensive tape like this, the 50 days moving average becomes a battleground, and until SPY can close back above it with conviction, the tone stays fragile and reactive. This ties back to the momentum acceleration signal on SPY because the slope of the recent move has clearly steepened to the downside. After the initial relief bounce on softer inflation, sellers step back in and push price lower with increasing force, which is exactly what this acceleration setup reflects. That tells us the tape is not calmly drifting. It is reacting fast to every headline about rate cuts, growth risks, and trade policy noise from this week. So, when downside momentum builds while price sits under the 50 days moving average, the burden of proof shifts to the bulls. In a market this jumpy, sharp countertrend rallies can happen, but until momentum cools off, every bounce feels suspect and fragile. At the same time, the Golden Cross context on SPY reminds us that the longer-term trend has not completely broken down. The 50 days moving average is still above the 200 days, which means structurally the broader uptrend from last year is technically intact despite this week of turbulence. But here is the tension. Price is now pressing closer to that 200 days area, and if fear accelerates, that level becomes the next major line in the sand. So, this is where the market feels split in two: short-term damage versus longer-term structure. In a cautious environment like February 9th to 13th, 2026, traders respect the Golden Cross, yet they are watching for any sign that this defensive pullback could morph into something deeper. Meanwhile, this hammer at support on SPY shows that buyers did step in aggressively after the latest flush lower. A hammer candle at a key level often signals that intraday panic was absorbed, especially in a week where rate expectations and growth fears kept traders on edge. That reaction makes sense because falling Treasury yields offered temporary relief, even as equity momentum stayed fragile. So, this is the kind of candle that fuels short-term hope in a nervous market. But unless we see follow-through above the 50 days moving average, it remains a defensive bounce rather than a full-blown shift back to confident risk-taking. Shifting focus to QQQ, the Invesco QQQ Trust that tracks the Nasdaq 100, we see a similar close streak below the 50 days moving average, and that is a warning sign for tech leadership. Throughout February 9th to 13th, 2026, technology stocks struggled to build on the softer inflation print, even as Treasury yields move lower. That hesitation reflects deeper concerns about growth durability and how earnings will hold up if economic momentum cools later this year. So, when QQQ cannot reclaim the 50 days while the broader market is already on edge, it amplifies the cautious mood. In this kind of tape, tech is supposed to lead the rebound, and if it lags instead, the entire market feels heavier and more vulnerable. Meanwhile, the Golden Cross context on QQQ shows that the 50 days moving average is still above the 200 days, so the bigger structure has not fully rolled over. That long-term alignment tells us this is a stressed pullback, not yet a confirmed bear trend. But with price trading below the 50 days and volatility picking up during February 9th to 13th, 2026, the cushion between price and the 200 days becomes critically important. So, if tech cannot stabilize before testing deeper support levels, sentiment could sour quickly. In a market already rattled by shifting rate expectations and growth doubts, that long-term trend line is the last thing the bulls want to see break. At the same time, momentum acceleration on QQQ shows that the recent downside move has picked up speed rather than fading out. That lines up with the choppy reactions we saw during February 9th to 13th, 2026, where even good inflation news could not spark sustained buying in big tech. When downside momentum expands while price stays under the 50 days average, it signals that sellers are still in control of the short-term narrative. So, This is the final warning sign in this sequence, because if tech cannot slow this acceleration, the broader market will struggle to regain confidence. In a week defined by caution and fast rotations, rising downside momentum keeps everyone on edge. Now, zooming in on IWM, the iShares Russell 2000 ETF that tracks US small cap stocks, we actually see trend strength confirmed on this chart. That is fascinating because during February 9th to 13th, 2026, while large cap tech was struggling under its 50 days moving average, small caps managed to hold their broader structure. This relative resilience suggests that parts of the market are still pricing in softer inflation and the possibility of rate cuts later in the year. So, this divergence becomes critical, because if small caps keep their footing while the Nasdaq wobbles, it hints at rotation rather than full-scale panic. In a week defined by caution and fast momentum shifts, confirmed trend strength in IWM is a subtle but important signal. This ties back to the ATR percentile reading on IWM, which is sitting at a high level and signals elevated volatility. In plain English, small caps are not calm. They are swinging hard even if the broader trend still looks intact. That makes sense in a week like February 9th to 13th, 2026, where shifting rate expectations and growth concerns created sharp intraday reversals across the board. High ATR means risk is expanding, and in a cautious market environment that can amplify both rallies and sell-offs. So, even with confirmed trend strength, traders have to respect the fact that volatility in small caps is running hot. At the same time, the TTM squeeze signal on IWM tells us volatility compression is in play right before potential expansion. That means price has been coiling, and when that coil releases, the move can be explosive in either direction. In a week like February 9th to 13th, 2026, where inflation data, rate expectations, and growth fears all collided, a squeeze setup adds another layer of tension. So, this is a classic pressure cooker moment for small caps, because if the breakout aligns with falling yields and stabilizing sentiment, upside could accelerate fast. But if macro nerves resurface, that same squeeze can unwind to the downside just as violently. This ties back to the bearish twin peaks signal on the awesome oscillator for IWM, which warns that upside momentum has been fading beneath the surface. Even though the broader trend is technically confirmed, this kind of momentum divergence often appears before deeper pullbacks. In the context of February 9th to 13th, 2026, where the market reacted sharply to every macro headline, a bearish twin peaks setup adds a layer of caution to the small cap story. So, while IWM looks relatively resilient compared to tech, this indicator suggests buyers are losing steam. In a market already defined by nerves and fast rotations, that is not something to ignore. Now, zooming in on the 10-year Treasury yield, shown here as TNX, we see a clear close streak below the 50 days moving average. That lines up perfectly with what happened during February 9th to 13th, 2026, when cooler inflation data pushed yields lower and revived hopes for rate cuts later this year. Falling yields normally act as a tailwind for equities, but this time the reaction was mixed and hesitant. So, this divergence is crucial because if bonds are pricing in softer growth while stocks struggle to rally, it signals underlying caution rather than confidence. In a market already on edge, sustained pressure on yields below the 50 days reinforces the idea that investors are quietly rotating towards safety. This ties back to the trend channel and regime status on TNX, because yields have now pushed toward the lower boundary of that structure. When a market approaches the edge of a defined channel, it often signals a decision point rather than a smooth continuation. In the context of February 9th to 13th, 2026, the drop in yields reflects softer inflation and a partial repricing of rate expectations, but it also hints at rising growth concerns. So, if yields break decisively below this channel, it would reinforce the defensive tone we are already seeing in equities. In a cautious environment like this, bonds are not just moving, they are sending a message. At the same time, the Fibonacci impulse retrace setup on TNX shows yields sitting in a classic reaction zone after the recent drop. When a market retraces into a key fib level, it often pauses before deciding whether to continue the move or snap back. In February 9th to 13th, 2026, that retracement reflects how quickly traders reprice the rate path after softer inflation data. If yields stabilize here and bounce, equities could face renewed pressure from higher discount rates. But if the retracement fails and yields extend lower, that would reinforce the defensive undertone we have seen all week. Meanwhile, the close outside the lower Bollinger Band on TNX is a classic warning of stretch conditions after a sharp drop in yields. When price pushes beyond that lower band, it often signals short-term exhaustion rather than a smooth continuation. In the context of February 9th to 13th, 2026, that move reflects how aggressively traders rushed into bonds after the softer inflation print and rising growth concerns. This kind of extreme reading can lead to a snapback rally in yields, even if the broader trend remains cautious. In a market already fragile and reactive, an oversold bounce in yields could quickly ripple back into equities and shake confidence again. Now zooming in on Bitcoin against the US dollar, shown here as BTC USD, we see the death cross context still dominating the chart. That means the 50 days moving average remains below the 200 days, a classic sign of a longer-term downtrend that has not yet healed. During February 9th to 13th, 2026, crypto reacted to the same macro forces as equities, softer inflation and falling yields, but it failed to stage a convincing structural reversal. This reinforces the cautious tone across risk assets, because when speculative corners of the market cannot regain leadership, confidence stays fragile. In a week defined by whiplash and defensive positioning, the death cross on Bitcoin underscores that risk appetite is still under pressure. This ties back to the ATR percentile reading on Bitcoin, which is elevated and signals extreme volatility. In other words, price is not drifting quietly, it is swinging aggressively in both directions. During February 9th to 13th, 2026, crypto reacted sharply to every shift in rate expectations and broader risk sentiment, amplifying the moves we saw in equities and bonds. High ATR in a death cross environment is a dangerous mix, because it means the downtrend can accelerate quickly on negative headlines. In a market already defined by caution and sudden rotations, this kind of volatility keeps traders on edge. At the same time, the RSI exit from oversold on Bitcoin shows that short-term selling pressure has eased slightly. When RSI climbs back above 30 after being oversold, it often signals a relief bounce rather than a full trend reversal. In the week of February 9th to 13th, 2026, that small recovery fits the broader pattern we saw across risk assets, sharp drops followed by hesitant rebounds. This tells us that buyers are willing to step in tactically, but they are not yet strong enough to flip the larger downtrend. In a market still dominated by caution and macro uncertainty, an oversold bounce is relief, not resolution. Meanwhile, the fact that Bitcoin is closing in the upper 25% of its recent range shows that buyers are at least defending into the close. When an asset consistently finishes near the top of its daily range, it signals short-term demand even inside a broader downtrend. During February 9th to 13th, 2026, that kind of closing strength mirrored the choppy relief moves we saw across risk assets after softer inflation data. This does not cancel the death cross or the elevated volatility, but it suggests the selling pressure is not one-sided anymore. In a market defined by caution and fast sentiment shifts, strong closes are a small but meaningful sign that traders are still willing to step in tactically. Now zooming in on Apple, the technology giant behind the iPhone and one of the heaviest weights in the S&P 500, we see a clear close streak below the 50 days moving average. That is significant because when Apple trades under its 50 days, it often drags on overall index performance. During February 9th to 13th, 2026, even with softer inflation data and falling yields, Apple struggled to regain short-term momentum, reflecting broader hesitation in mega-cap tech. Investors are balancing hopes for easier monetary policy against concerns about global demand and growth durability. In a cautious market like this, sustained trading below the 50 days moving average keeps pressure on both Apple and the broader market narrative. This ties back to the trend channel and regime status on Apple, because price is now pressing against the lower boundary of that structure. When a leading stock tests the bottom of its channel, it often becomes a high-stakes decision point for the broader market. In the week of February 9th to 13th, 2026, that pressure reflects how quickly sentiment shifted from inflation relief to renewed caution about growth and earnings durability. A clean break below this channel would confirm that sellers are gaining control in a stock that typically anchors index stability. In a tape already defined by nerves and defensive rotations, that kind of breakdown would add fuel to the cautious mood. At the same time, the Golden Cross context on Apple shows that the 50 days moving average is still above the 200 days, so the longer-term uptrend has not officially broken. That creates a tension between short-term weakness and longer-term structure, especially in a week like February 9th to 13th, 2026, when macro headlines kept shifting the mood. As long as that Golden Cross remains intact, longer horizon investors can argue this is a pullback within an uptrend rather than the start of a deeper slide. But if price continues to trade below the 50 days and starts threatening the 200 days, the narrative could change quickly. In a market already defined by caution and fragile confidence, that long-term support level becomes a psychological anchor for both bulls and bears. Now zooming in on Amazon, the e-commerce and cloud giant, we also see a close streak below the 50 days moving average. That is another sign that mega-cap leadership is under strain, not just in Apple, but across the broader tech complex. During February 9th to 13th, 2026, even as bond yields fell on softer inflation, Amazon failed to reclaim short-term momentum, reflecting cautious positioning ahead of ongoing growth and margin debates. When a stock of this size trades persistently under its 50 days, it weighs on index stability and investor confidence. In a market already defined by defensive rotations and fast sentiment swings, this kind of weakness in Amazon reinforces the fragile tone. Keeping that pressure in mind, this AMZN trend channel snapshot is the kind of thing that keeps traders up at night. It shows Amazon trading below the lower band of its rising channel for 10 straight sessions, about 5.8% under that boundary, with the deepest close around 6.2% on February 12th. And even though the channel itself scores 83 out of 100 for quality, the lower line is acting as resistance and the 50 days SMA is still overhead. That sets up a simple fight next week: reclaim the channel and the 50 days, or accept that the path of least resistance is still down. Meanwhile, the RSI oversold reading on Amazon confirms how intense the recent sell-off has been. When RSI drops into oversold territory during a sharp down move, it signals exhaustion, but not necessarily a durable bottom. In the week of February 9th to 13th, 2026, that kind of extreme momentum reading reflects how quickly traders de-risk large-cap tech despite softer inflation data and falling yields. So, while a short-term bounce is statistically possible from these levels, the broader trend and channel breakdowns still hang over the chart. In a market already defined by fragile confidence and fast reversals, oversold conditions can spark relief rallies, but they do not erase structural damage. At the same time, Nvidia Corporation, the semiconductor powerhouse behind much of the AI boom, is now showing a clear current pullback context on the daily chart. After an extraordinary multi-year run driven by relentless demand for AI accelerators and data center chips, this recent retracement reflects how crowded the trade had become into early 2026. In the week of February 9th to 13th, 2026, even strong structural stories like Nvidia were not immune to profit-taking as traders reduced exposure across high-beta tech. So, this pullback does not automatically invalidate the longer-term uptrend, but it does signal that momentum has cooled and that key levels such as the 50 days moving average are back in focus. In a market where leadership is being questioned and volatility is picking up, even the strongest names are being stress-tested. This ties back to the RSI 50 cross-down on Nvidia, a classic momentum warning that buyers are losing control in the short term. When RSI slips below the 50 line after a strong advance, it often marks a shift from aggressive dip buying to a more cautious tone. In the volatile week of February 9th to 13th, 2026, that loss of momentum aligned with broader de-risking across mega-cap tech as traders reacted to shifting rate expectations and stretched valuations. So, unless Nvidia can quickly reclaim that 50 level on RSI and hold key moving averages, the path of least resistance remains fragile. In a market already on edge, even small technical cracks in leadership names can amplify nervousness and fuel sharper swings. Meanwhile, the golden cross context on Nvidia reminds us that the longer-term structure is still technically constructive. A golden cross, where the 50 days moving average rises above the 200 days, typically signals that the primary trend remains bullish even during sharp pullbacks. In early February 2026, that bigger picture strength stands in contrast to the short-term momentum loss we just discussed. So, the real tension here is between a powerful long-term AI-driven uptrend and a fragile short-term tape that has been shaken by volatility and shifting rate expectations. In a market that feels one headline away from another swing, that kind of mixed signal can either fuel a dramatic rebound or set up an even more violent flush. Shifting focus to Meta Platforms, the company formerly known as Facebook, we now see a clear death cross context on the daily chart. A death cross, where the 50 days moving average falls below the 200 days, signals that medium-term momentum has rolled over and that sellers have gained structural control. In the tense week of February 9th to 13th, 2026, that bearish crossover underlines how even dominant digital advertising and AI-driven platforms are not immune to the broader rotation and risk reduction across mega-cap tech. With sentiment already fragile and volatility elevated, this kind of signal can attract systematic selling and reinforce downside pressure. In a market walking a tightrope between resilience and breakdown, a death cross on a heavyweight like Meta adds another layer of caution to the overall picture. Looking deeper into Meta, this Fibonacci impulse retrace setup suggests the stock is approaching a technically decisive zone. After a strong prior advance, a retracement toward key Fibonacci levels often becomes a battleground between dip buyers and momentum sellers. In the volatile stretch of February 9th to 13th, 2026, that retrace reflects how investors reassess growth expectations and risk appetite across large-cap tech. If price stabilizes around a major Fibonacci level and holds above the 200 days moving average, bulls could argue this is a controlled pullback within a broader structure. But in a market already wrestling with uncertainty and sharp rotations, a clean break below those retracement levels could accelerate downside pressure and intensify the cautious tone. Finally, this meta trend channel and regime status view brings the bigger picture into focus. Price is pressing against the lower boundary of its established channel, which turns that level into a critical line in the sand for the coming sessions. In the fragile environment of February 9th to 13th, 2026, where leadership has been wobbling and volatility has picked up, a sustained move below that channel would reinforce the broader defensive tone across mega-cap tech. If bulls manage to defend this structure and reclaim short-term moving averages, the narrative could quickly shift back toward stabilization. But in a market already walking a tightrope, another confirmed channel break would likely amplify risk aversion and keep sentiment firmly on edge. Looking at the economic calendar, there's a high-impact event scheduled for Wednesday. On Wednesday, February 18th, 2026, at 7:00 p.m., the U.S. FOMC minutes will be released. This is a significant announcement, carrying a high-impact rating. Markets will be closely scrutinizing these minutes for any fresh insights into the Federal Reserve's future monetary policy decisions. Now, zooming out from all these individual charts, what we are left with is a market that feels like it is one headline away from either relief or another sharp flush. Price action during the week. February 9th to 13th, 2026 has been choppy, emotional, and brutally unforgiving for anyone without a clear plan. The VIX spikes we have seen underline that nervousness, with volatility flaring up quickly whenever yields or macro data surprise to the upside. So, this is not the kind of tape where you wing it and hope for the best. It is a tape that demands a risk plan, clear invalidation levels, and position sizing that can survive sudden air pockets. Because in an environment like this, discipline is not optional, it is survival. Wrapping this up, what a nerve-shredding week that was. Volatility kept traders on edge, with sharp intraday swings and a VIX that signaled persistent unease rather than calm confidence. So, this is not the kind of tape where blind optimism pays off. It is a market that punishes complacency and rewards discipline, especially with yields, megacaps, and crypto all flashing mixed signals. At the same time, risk is not the enemy if it is managed. With key levels like the 50 days averages and major Fibonacci zones now clearly defined across the board, the next move will likely be decisive. Stay sharp, respect the volatility, and come prepared. Because in markets like this, hesitation can be costly, but so can overconfidence.